The up thrust, now this is important because when you see these in the right place, very, very important. Now the up thrusts are there for a good reason, and that is to trigger stops in a weak market. Remember the word that I just used there, a weak market. We don't want to see up thrusts in a bull market because they're not genuine. They're a polar bear in Hawaii, as you used to say, Tom. Now,
Yes.
what does that mean? Well, it means they're in the wrong place. If you're on the beach in Hawaii and you're sunbathing, and you wake up and look up, there's a polar bear standing over you,
There's something
two
wrong.
things have happened. You've had too many martinis,
Yeah.
or it's escaped from the local zoo. But it's not supposed to be there. Mother Nature did not put polar bears in Hawaii. Now, if you're in the Antarctic and you're in your tent and you poke your head out and there's a polar bear, you know it's in the right place. The Antarctic's cold. So we know that an upthrust after serious weakness is in the right place. However, an upthrust after climactic action in a bull run should be ignored because it's not genuine. Philip, you agree?
I do, yeah. Except I would say polar bears only in the Arctic.
Oh, are they? Okay, Antarctic. Well, I'm close, aren't I? I just said the Arctic. Now you're picking me up on small, in a cold, snowy place. How about that? But
Norfolk, Canada.
Norfolk, Canada. Yeah, you get the point. Okay. So, however, many chart patterns look like upthrusts but fail to live up to their promises. The upthrust has to look right. It has to be in the right place. Many are created in a strong market by gapping up at the opening, then falling off to rest, only to carry on up. The genuine ones are easy to see, as we're going to show you. Basically, you should have sign of weakness in the background, not sign of strength. Let's repeat. The genuine upthrust has a sign of weakness, just like no demand, in the background. So, Philip, look at this chart here that I've got. Now, we've got the mushrooming over at the top. We've got some very serious weakness on the bar that I've pointed the arrows at initially there. That's a very nice weak bar because it's approaching an old top. It's a wide spread, but it closes in the middle. Now, that's very important. And the next bar is down. Why is that important where the close is on that bar, Philip, on that volume?
Well, the fact it's closed in the middle shows that that volume must have contained a huge amount of selling, because otherwise it would have closed right up on the high with that wide spread. So there was clearly, when you see ultra high volume, there's a lot of buying coming in, but if you see it close in the middle, there must also be a lot of selling as well, and that selling is absorbing the buying that's coming in.
Yeah. Now we notice here as well that we've got this mushroom. So we are definitely in a downtrend.
Yes.
Because we've got weakness on the bar marked, and we begin to go up on no demands. Now, as we fall to this level here, we get a very, very nice no demand bar, one of the best I've seen for many, many a year. This is a beauty, isn't it? See, it's in the right place.
Absolutely.
Narrow spread, close in the middle, next bar down. However, the professional money will send Tom a telegram, will send all of us one, because they say if you missed that, if you didn't believe it, and you've seen this weakness, you've seen it come off, you've seen no demand, we're going to give you a third bite at the cherry, and here it is, there. Hidden upthrust on very low volume. Now, talk a little bit about that bar, Philip, because you can see upthrusts on high volume, which I know shows a lot of selling because it closes on the low. But when I see a low volume upthrust bar like that, it tells me that as the price is pushed up, professionals aren't really involved, which is why it collapses on the low,
yes.
Hence the low volume. Talk us through how you see that, a high volume upthrust compared to a low volume upthrust. What are the differences?
Well, the high volume upthrust is telling you that there's selling or supply by the professional traders on that bar. A low volume upthrust is telling you that the professionals are not interested in the upside on that bar. So if volume is low, there may be some activity by the herd, a small amount of activity, but there's certainly no interest by the professionals.
And we notice two other principles on here that we're going to come to. We see a wide spread down bar here closing right on the low on very high volume, and we see it again here. But the close on the low is the key. Why? I mean, what happens if it closed up in the middle here on that volume?
Well, if it closed up in the middle, there must have been some buying coming in for it to do that.
So really here, we can infer that because it closed on the low and tries to go up on no demand, then you get another one and it goes up no demand up. If you see that after that weakness, that's a very high probability trade to the short side.
I'd say the first one you've highlighted there is actually the weaker of the two bars.
This one?
No, the one just to the left of that one, the down bar that you're highlighting.
Because it takes out this bar here,
It takes out the support to the left, and there's an increase in volume. It's not ultra high volume. Well, it is ultra high volume on the program, but if you're comparing it to all the other bars on the chart, it's not the highest volume. there's enough effort there to push down through the support level without being too much.
And it does. It closes on the low and there's no demand there. So here is a setup that you must learn and take in, because if you see this is a currency contract, okay, it's currency futures, but this is, again, can be seen in stocks. I've seen it in, we saw it in the gold market when everyone was bullish gold. Similar thing happened. We get a wide spread up, closing in the middle. Now the close in the middle on that ultra high volume should get your trading antenna saying, hey, something's going on. What's going on here? The next bar closes lower, as we can see. So we know there has to be more selling than buying in here. We move sideways initially. Okay, that often happens after weakness. Okay, that often happens. It just goes sideways until we get the sudden surge down, which is what I like to put sell orders in below these areas here. When I see high volume like this, put a sell order in to get pushed in on this bar here. That really means that I'm not getting whipsawed around, because I know there's sellers there, and if they're going to push it through, they'll use this tactic here. Widespread down, closing on the low. Now, Alan's asked, Philip, can you repeat for us what the difference between a high volume upthrust is and a low volume upthrust, and be very clear on it so everybody's got it. What you're seeing on your chart in this example, by the way, is a low volume hidden upthrust. It's hidden because it closes lower than the bar behind it, but what makes it an upthrust, the high of the bar is higher than this bar here, the top, and the volume though is very, very low. And if you think about the price action and what's going on, the price has tried to push up, the volume is declining, and then it's just collapsed on the low with the next bar down. But just repeat, just so people have got that.
Right, the low volume upthrust shows that there's no professional activity on that bar.
Right.
So it's been marked up probably at the open, perhaps there's some news or something come out. The professionals are not interested in that bar, so if they withdraw their interest, the price just collapses down to the low. Right. Now, with a high volume upthrust, the professionals are actually selling into that bar, because an upthrust, remember, is going to close near its low. So the fact it gets marked up at the open and collapses down to the low on high volume shows there must be selling or supply coming in on that bar.
Well, let's have a look at a high volume upthrust then in gold, which we just talked about. Now, again, you've got the same principles here. Now, Tom, many traders think they're great traders when they put their stops nice and close to the market, because they're taught money management and risk. And hey, guess what? If you take a trade in the S&P, be 4 ticks away from the live edge, and then after 15 stop outs and their account gone, they say, oh my goodness, what just happened? But the upthrust is what is used to catch them, or indeed the opposite, a shakeout.
Yes.
Now, tell the listeners here why the upthrust is used, and why, when you see it in the right place, it gives you a real clue as to what the smart money are up to.
Well, the upthrust, once an upthrust appears, after, you keep saying this, after you've seen weakness in the background, then that's done deliberately to catch the stops. Remember, there are not hundreds, but there are probably thousands of stops above and below these actively traded markets. It pays to mark it up, trigger all those stops off, encourage people to go long in a weak market, panic those people to sell already short, and it goes on and on. It's very, very profitable if they can do it. Not always the market conditions allow them. Don't forget, it can cost them money if they're not careful. But that's the upthrust. And if you've got weakness in the background, it's a sure sign of confirmation of more weakness.
A question comes in from Tom, and he's just saying, which is the strongest sign of weakness? Is it you know, a stronger? Is there a stronger indication?
Yes.
Active selling on the up bar, or just a no demand bar? Which is the stronger indication of a move?
Well, the strongest signal, of course, as you keep saying, end of a rising market. When you've seen a bull move, it's been going up and up and up. People are looking at it, they think, oh my God, how much further is going up? I should really be on this. And then suddenly some fantastic news comes out and it's gapped up, and you think, oh right, I better get in on this before I miss out any further higher prices. The news is good, look, so it's got to go up. But when we look at the chart, don't forget the chart is a language. You're reading a language, learning a language. When you see that's gapped up, they gap it up in the cash market, the spread is narrow, the volume is very, very high, and if it's in fresh or new high ground, it's an almost guaranteed top for that market.
Now, I think Tom's, I understand where he's coming from here on the question, because if you look at a bar in isolation, Philip, and you say, well, look, no demand, is that stronger than a high volume upthrust? In isolation, it doesn't mean anything.
Nothing at all without looking at the background.
Correct. So a no demand bar after end of a rising market is massively powerful.
It is.
Exactly.
A no demand bar, okay, in a market that's going up with strength in the background means nothing.
Exactly.
You don't really want to touch it.
Nope.
So the answer to your question there, Tom, is simple. We look more than at one bar. We look at them in context, and I try to look at them within a 25 bar period. That tends to work for me. Now, I found, though, that is nothing is mathematical in the markets because they're driven by human beings. It's a fractal market. It does things strange. I mean, if you had tomorrow, if you were using a moving average and tomorrow we had a major terrorist attack, the market would do something. Okay, you couldn't predict it yesterday in past price. You may be able to catch it in the morning. Now, I'll give an example. United Airlines put a story out a couple of years ago that were going out of business. They didn't put it out. Someone did. And someone made a lot of money on the resulting move. So this is why professional money, which we follow in the volume, drives the market. But everything in VSA has to be in context. This is why you'll notice that all the charts, we're not focusing on just a bar. We're focusing on the story, the unfolding story, and then we're looking for the entries when we have strength or weakness behind us. Now, at the moment, we're focusing on weakness, okay, and here we see a widespread down bar. Now, this was gold futures in 2008. We saw almost the same thing 2 years later because the markets work the same way. Get everybody bullish gold, tell them the dollar is weak, where the dollar is now strong. I mean, they all work in alignment. This is why, if you look at the dollar against the pound, it's strengthened massively over the last 6 months. But if you read the newspapers, Bernanke's going to kill the dollar. Well, sorry, not at the moment he's not, because the chart tells the truth. The gold market apparently was going to break and just keep going and keep going. But we all know at some point, just like the oil market, they're going to catch you. Here, what they did is look at the volume on this bar. It's the highest volume. It comes down, closes on the low, and then goes up on no demand. And then they give people hope. They say, okay, well, anyone that's long in here, okay, we don't want you to sell yet, so we'll bring the price back up into this bar up here. So you think it's going to go up, you can add to your position, it's a breakout, and look what happens. It closes on the low, the volume is the highest, and the next bar confirms it. That is an ultra-high volume upthrust. It's the opposite, okay, to a low volume upthrust, and that is actually an ultra-high volume hidden upthrust because it closes lower than the bar behind it. But notice that the high of this upthrust is higher than this bar here, and actually what is interesting, it's into the body right of this bar here, which is a serious sign of weakness. Okay, is there any questions on that one? If not, we're going to go straight to, well, this is the same principle as well, look. You've got all the principles here. You've got sign of weakness in the background. In fact, Rich, if I could ask Philip, this is one you, I know, selected. UK land, it's a FTSE stock. Do you want to talk us through the yellow area first and then the reaction at A and B, which are both good upthrusts?
Well, this is one of the largest UK property companies, British Land, which has been around for, I think, over 100 years. And if you look at the yellow area on the left of the chart, you can see Gavin has highlighted the up bar, which is on a very wide spread. It's closed right up near the highs on ultra high volume. Now, for that to have been buying, if that was all buying, you wouldn't then expect the next bar to be down. So the fact the next bar is down is telling you there must have been supply in on that bar. And as you can see, the market then comes off from there. When we go over to point A, we've got a lovely example of an upthrust. We pushed back up into that area again. The market has rejected it. What's happened is you've got, looking, is that low volume on there, Gavin? Or?
Yeah, it's pretty low.
Pretty low. I think it's the blue one, isn't it?
Yeah, these are both examples of low volume upthrusts.
Yes, they are. What's actually happened there is that the professionals have done their selling back in the yellow area. The herd have done their buying. And then when you get to A, there's no more buying orders left from the herd. So the price gets marked up probably on some good news. Mm-hmm. There's nobody who wants to buy in the herd. The professionals are not interested in buying, certainly at that level. So the price just collapses back onto the low on low volume. And B is just a repeat of that process. So
it's interesting, but so professional money are supporting at this level here, but they're not interested in higher prices here, and actually after B this thing collapsed.
Yeah.
But it was interesting, it went in phases. Okay, because if you'd have gone short on that upthrust, when it comes down to this bar here, Okay, we notice we get a little test bar. I think it's in there. It's a little bit of buying. They support it, bring it back up, and then bring it back down again. That's why a market sometimes can be very devious, and that's why you've got to watch. If you're on a daily chart, you'll see this is actually a sideways moving market, but eventually after B, it did collapse and fall, didn't it?
They're probably doing a little bit more distribution, because I'm looking at the bar before B. That's an up bar, and that shows a little bit of selling in there. So I suspect that they still had a little bit of selling to do, which is why they were holding it up.
Chris was saying on the ES, which is what I trade, he's using an 8 to 10 tick stop and gets caught by the 1 tick. I'm actually using a 12 tick stop, Chris. That's what I've used for a long time now. 3-point stop. That's quite a wide stop for many traders, but I just trade less contracts than I usually trade. And I'm seeing a lot of traders now, because the spreads on some of the bars are 3 or 4 points on the S&P. They're just getting killed because they suddenly, boom, there's a big wide spread. The analysis is spot on. But because they're dealing with the big money that can move the market that size, they're only retail traders, maybe trading a $10,000, $20,000 account. You can't put too wide a stop in sometimes, and that's where it gets difficult. But you only have to catch 1 or 2 good runs, and they do happen now. Decent runs on the S&P, and time your entry. And again, stop management is and we're going to talk today a little bit about where to place stops. But it's so difficult because every market and every chart is different, and trying to guide someone on stops is a difficult one. Was there any short positions in the yellow area? I personally there wouldn't have taken anything because you're in an uptrend.
Nothing that I can see.
I wouldn't take it. And the reason I wouldn't, Evan, we're still trending up, as you can see. And even here, although we get 2 down bars, that bar here, which I don't really class in the yellow area, but it is a wide spread down on high volume. It doesn't really give me any entries in there. If you were using the trending system in Trade Guide, it would all be green up here. And that's just an alert that something's happening. Now, if I saw that after that, that would definitely attract my attention, especially if I get any no demand bars, which we get here, look, like very low volume up bar. Then we get another up thrust here. So you get lots of weak bars if you count them across here, and you get a very weak bar here. That's incredibly weak. It tries to penetrate this bar. It goes up, the volume's very low compared to the other bars, falls on the low, the next bar is down, and then look what happens here. We get a narrow spread, and then we try and go up and collapse. So those bars there, because of this background, would be more interesting to me. But again, looks easy because we can look back at this, but that could take, is a daily chart, that could take 2 or 3 months to set up. And that's where people are impatient. They want to be in the market, and that applies to a 1 minute chart too. They want to get in and sometimes get stopped out, and we're going to teach you, you've got to be patient.
Also, bars A and B are right back into the body of that high volume bar in the yellow area, which is the other thing too. Yeah,
well here you see, when you're looking at a widespread bar like that, we've got the high is up at the top here, so you draw a line on there to see if we come up to it, okay? But also you're going to want to know where it started, which is on this low here. Now if you look, see the diagonal line below it on the schematic, you can see if you drew a line along there, you would see how important that bar is on the high volume, because on the low of the bar, it's pushed up here, rejected it, and here it's gone up, tried to close just above the low of the bar, and the next bar's rejected through it. So that bar there is a very important bar, and it's the highest volume on the chart. Always, as I say, pay attention to the highest volume on the chart. So Janet, that just confirms what you just suggested. And when we get to trigger numbers at the very end of the presentation, I'll just show you the NASDAQ. It's one chart, or sorry, 2, will show you everything you need to know about identifying where trigger bars are. Okay, on the right of this chart, you have a 2-bar reversal end of November, then high volume down bars moving sideways after a down move, suggesting accumulation. Okay, so up down here, we're looking at, let's have a look. So we're coming up to the end of November here, little reversal bar here. I wouldn't say there's any, can you see, I can't see any accumulation here, Philip, can you? This looks all weak to me. You've got up thrust, you've got, you see anything, any strength in those bars?
There's a little bit in there.
A little bit of support along this level
on
here.
Those down bars.
Yeah.
But
you've got this bar here, look, and it does close up higher. That's the 2 bars that you're talking about. It goes up here, but there's no demand. Look, there's not, and then you've got an up thrust. So it's not going to take out these highs here. It rejects the highs, but there is definitely. I mean, I think the stock carried on going down, didn't it, Philip? If I recall on the chart.
I can't remember offhand on
that.
No,
I'm pretty sure it did. I think it rejected. It broke these support levels and then carried on going. And I think the reason it did, because we had, if you connected all of these, this bar and this bar, it was in a clear downtrend, and you'll find that the line would have gone through here as well, and it rejected it. But, that's this setup here, you've got so much weakness behind you, and I don't really see a great deal of climactic action or stopping volume here at all. Do you see?
And I can also see some weakness on the up bars when it goes up as well.
Well, here on this bar here, this is high volume on this up bar. Even though it looks like a little reversal bar, it's not a genuine reversal because it would close up here and it would start there. It's dipped down too hard to be a real genuine 2-bar reversal. But we'll kind of come to that, Morris, when we get to signs of strength. Okay. So let's just summarise. Shorting after you've seen an upthrust. This can and does appear in an uptrend, but is not a genuine upthrust because you are in an uptrend. It is a far more powerful short in a downtrend. Do not short an upthrust in an uptrend. It's in the wrong place. Remember that. This is a powerful short when there is a downtrend in place and you see this push through the top of the downtrend channel. Now remember, when we're in a downtrend and it tries to push up through the top of the channel on high volume or low volume, and it's an upthrust, it's a serious sign of weakness. You must have weakness in the background.